Hi, so we are going to study a little bit about input tax recovery. Uh, in conducting their business, a taxable person will incur expenses which are subject to VAT. The VAT can be recovered by the taxable person subject to meeting certain conditions, and this will ensure that the VAT will not normally be a cost to such a taxable person because it is refundable, right? Input VAT. You can recover input VAT. Where the taxable person is not able to recover the VAT, which is input VAT, incurred in respect of goods or services, the person is in effect treated as the end consumer for those goods or services. So naturally, the whole VAT, value added tax, depends on the end consumer. In the end, it is the end consumer who bears the VAT that has generated across the supply chain. So that is why that when the cycle, when the supply chain of the VAT stops at one person, like take the example of individuals like you and me, when we go to a hypermarket like Lulu or Carrefour, etc., and we buy something, they give us a small simplified invoice and we end up paying the VAT. We bring the goods or merchandise home, we consume it, we eat it, we wear it, whatever the case may be. But that's it, that's the end of the supply chain. So entire VAT across the supply chain is actually borne by the end consumer, and all those matters of inflation and cost of living, etc. Because of the VAT, if you really think about it, the market players or the nodes or trigger points across the supply chain, they act as only agents. They purchase merchandise from the previous supplier, and then they become suppliers themselves and sell it to the next person or next guy, and that guy then acts as a supplier, sells to the next. Across the supply chain, uh, VAT keeps getting collected from the buyer, and the new VAT that is it is charged on to the customer. Until what point? The cycle has to end somewhere, right? The end point is that consumer who does not further pass on the burden of the VAT. Anyways, when a person purchases goods or services, the VAT incurred on the purchase or expense, that is called the input VAT. Okay, input tax. In other words, VAT charged by the supplier is input tax of the recipient. Now, we are going to talk about conditions. What conditions apply for the recovery of input tax? So, for input tax to be available for recovery, the following conditions must be met. What are those conditions? The person is a taxable person and is registered for VAT. First of all, the person can only recover input VAT if that person is a taxable person and that person is registered for VAT. The taxable person has purchased the goods and services to be used or intended to be used for making supplies under the Article 54 of the VAT law. So, meaning the purchaser is going to make further supplies. That taxable person will be able to recover VAT. The supply of goods or services must have been made for business purposes. So what are business purposes? Basically, business is done with a view to earning profit, right? And you know, it is done in a, that definition of business. It is done in an independent basis, regularly, ongoing basis, etc., etc. So it is done from a viewpoint of doing business. The VAT is incurred for the purpose of business. The person must hold the required evidence of their purchase, and the person must pay or have the intention to pay for the supply within a specific time. We're going to look at the time limits for making the payments as well. It is going to come ahead. In addition to these conditions, input tax must not be specifically blocked from recovery. There are certain cases where input VAT is blocked from recovery. The biggest situation is exempt supplies or out of scope transactions. If any VAT is incurred before making exempt supplies or any out of scope transactions, if the VAT pertains to such transactions, that cannot be recovered. And by the way, this inability to recover input tax is also one of the criteria of exempt supplies. We might have read or discussed earlier on as well. Recoverable input tax. How much amount of input tax that we paid can we recover? Let us look at that. Under Article 54 of the VAT law, a taxable person must deduct input tax charged on goods or services supplied to that taxable person where they are used or are intended to be used for making what? Taxable supplies. Supplies that are made outside the UAE, which would have been taxable supplies had they been made in the UAE. Usually, this could be exports. And a third situation, supplies of financial services, which would have been exempt supplies. Now, this is a very interesting scenario, and it can be examined as well in the uh, UAE VAT diploma or any other diplomas, or for that matter, ACCS tax and regulation exams. So this is an interesting scenario. Supplies of financial services. We know interest is a financial service or insurance premium is a financial service, and they are exempt. They would have been exempt supplies if they were made in UAE, provided the place of supply of these services is outside the UAE, and the recipient of these services is outside the UAE, provided that the place of supply of these services is outside UAE and the recipient is also outside UAE at the time these services were performed. So what are these? Why are we reading this? Because a taxable person may deduct input tax charged on goods or services to that taxable person where they are used or intended to be used for making such supplies that we have just read, three of them. So we can recover input tax. The term outside the UAE in this instance means that the recipient only has a short-term presence in the UAE of less than 1 month. Now, again, it's a memory hook point. Sometimes in the exams, such as the UAE VAT diploma or other ACCA's tax and regulation, this can be asked. What is the duration of stay? If it is less than 1 month, then that person, while he was in UAE, but for a very short time, less than 1 month, he will still be considered as outside the UAE, or their presence is not effectively connected with the supply. So, if a person we supply something to we are a taxable person and we made a supply to a foreign company and their representative was here in UAE, even for a small time as well, in connection with that particular supply, then it will no longer mean that the supply was made outside UAE. That's a very tricky part, and it has been examined extensively. Pre-registration input tax. Usually all startups, when they start, their revenues are very small, like they gradually pick it up, right? And they are not registered naturally until and unless they reach that 375,000 dirham threshold. So until that point, when they reach that threshold, they keep incurring expenses. They keep paying the input tax, but the poor guys, they are not able to recover that input tax. Why? Because they are not registered. That is the pre-registration input tax. A taxable person may recover recoverable input tax incurred before tax registration provided certain conditions are met. What are those conditions? The deduction may only be made in the person's first tax period following registration in relation to a payment for the supply of goods and services prior to the date of registration and the importation of goods prior to the date of registration. Is there a time limit specified here? Do you see a time limit? No, provided that these goods or services were used to make supplies that give the right to input tax recovery after tax registration. So that's a big help provided by the Ministry of Finance to the taxable persons. So if they have incurred input tax before they gotten registered, there is no time limit. You can, claim all the input tax that they have incurred. VAT incurred before registration may not be recovered in the following instances. Which instances? The goods or services were not used to make supplies that give the right to input tax recovery after tax registration. or were also used for purposes other than making taxable supplies. So a car was there, and that car was utilized for private use of the CEO, for example. Now that's not a business purpose. So will you be able to recover that input VAT? No. The answer is no. If the services were received more than 5 years before the person registered for VAT, so yes, there is a time limit, and that time limit is 5 years. So the previous point that when I said that there is no time limit, that was wrong. Actually, it is 5 years. The time limit is there, and it is 5 years. If the person moved the goods to another implementing state before registering for VAT in the UAE, if the person moved the goods to another implementing state, only four implementing states are there in GCC who have implemented VAT laws, right? So if the person moved the goods to another implementing state before registering for VAT in the UAE, then any input tax incurred on those goods will not be recovered, will not be recoverable. In the case of capital assets, VAT may not be recovered. So what are capital assets? There's a full-fledged separate discussion on that, a chapter on it. Capital assets are, really big, large assets usually. Minimum criteria later on we will discuss that has been provided as 5 million dirhams or more. Only those things will be capital assets, among some other conditions. So, but the point is that VAT may not be recovered in respect of the portion already depreciated before the person registered for VAT. So that's a very, very interesting and important point. Let's say there was a car, right? And it had a depreciated value. Okay, car may not be the right example here because car does not come in 5 million dirhams. Let's talk about plant and machinery, which cost, let's say, for that matter, 10 million dirhams. And the useful life of the plant and machinery was, let's say, 10 years. And the company got VAT registered only after, let's say, 1 year's time. For almost a year or so, the company was operating, but testing phases were there, and the runs were happening, and market testing was happening, etc., etc. So the plant and machinery got depreciated for 1 year time. That 1 year will not be, the VAT pertaining to that 1 year will not be recovered for this particular capital asset. In case of capital assets, VAT may not be recovered in respect of the portion already depreciated before the person registered for VAT. This means that the amount recoverable input tax is limited to the tax portion included in the net book value of the capital assets at the date of registration. The net book value, which is net of depreciation at the time of registration. This is a key point, and it's a highly examinable point. A tricky question can appear in the exam on this. Supply for purposes of carrying on a business. The goods and services supplied must have been received in the course of carrying on a business. That's a criteria. Goods and services must have been supplied must have been received in the course of carrying on a business. So Article 1 of the VAT law defines the business as any activity conducted regularly, ongoing, independent. These are the three biggest criteria to define business, but by any person in any location, such as industrial, commercial, agricultural, professional. So many different categories are there. Excavation or any related use of tangible and intangible properties. So business can happen through tangible properties, but intangible, patents, maybe a software, all of this is possible. Intangible properties is also business. Determining whether a supply is made in the course of carrying on a business for VAT purposes can be subjective. Whether a supply is made in the course of business, it has to be determined, it has to be analyzed. And the facts of each case must be considered in reaching a decision. It is important to note that it is not necessary to link every purchase with the onward supply in the business's accounting system, particularly as some purchases may be consumed by the business or used in the day-to-day running of the business rather than being onward supplied, right? Instead, the business must be able to identify expenses which are directly attributable to the activities, core activities, SIGA. core income generating activities of the business that give rise to VAT recovery and expenses that are attributable to activities which do not allow for VAT recovery. So there are some types of activities in the business that might not be directly related or attributable to those activities which give rise to the revenue, or and naturally because of that they become eligible for VAT recovery. So government and entities and charities, there are particular special provisions for that. Article 57 of the VAT decree law stipulates that government entities and charities are entitled to recover the full amount of input tax as determined in a cabinet decision issued upon recommendation of the minister. Wherever the word minister comes, that means finance minister, in accordance with the following criteria. So we're talking about what? Government entities and charities. Input tax paid by the government entity for the purposes of its sovereign activities. So a government can recover input tax for furtherance of their sovereign activities. So this is a terminology that has been defined in Article 1, sovereign activities, the activities done in sovereign capacity. So input tax paid by the charity. This was for government, and this next one is charity for the purposes of its relevant charitable activity. Every charity, every NGO, they have a mandate, they have a charter which defines why that NGO is operating, why are they granted the license to operate. So if the input tax was incurred for the core activities of the charity, then that VAT will be recoverable. As an exception to the above, the following will be excluded from recovery. What will be excluded? Tax excluded from recovery on as specified in the regulation. So there might be certain instances which might have been elaborated ahead for that input tax, which is excluded from recovery, or tax paid for goods and services used to perform exempt supplies. Now, this criteria we should always remember that for exempt supplies we cannot recover uh, input tax. And attribution is a key factor here. So we do not simply take the input VAT and apply a recovery percentage on it in the ratio of exempt versus taxable supplies. No, that's not how we do. We first of all allocate, we attribute, we divide input tax into three pools. That input tax which directly relates to taxable supplies, that's the first pool, first part. Second part of the input tax, portion of the input tax is that input tax which directly relates to exempt supplies. Now this input tax will be blocked. This is a loss to the company. We cannot recover that. And then there will be third part of the input tax which remains. Sometimes it is referred as residual input tax or mixed use input tax. On that mixed use input tax, we have to apply the input tax recovery percentage. We are going to learn it ahead. Goods and services not used for business purposes. In certain circumstances, goods or services will be used partly for making supplies that allow for the recovery of input tax. In certain circumstances, goods or services will be used partly for making supplies that allow for the recovery of input tax, and partly for making supplies for which VAT is not recoverable. For example, exempt supply. Where an expense is used for making such mixed supplies, the taxable person must determine the portion of the input tax that can be recovered. Certain expenses may be treated as follows: wholly private use. Okay, in this case, none of the VAT incurred is recoverable. So a car is there and it is being used only for private use. That amount of input tax that pertains to that car, whether it is for the fuel, whether it is for maintenance of the car, whether price of the car, none of that would be recoverable. Part business and part non-business. In this case, the VAT incurred is only recoverable for to the extent that it relates to the taxable business activities. So the rest of the VAT will be expensed out. It will become a loss for the company. The business will need to use the calculation set out in Article 55 of the regulation. It will be discussed in the next chapter, but we are going to continue to discuss more provisions. Registrant holds required evidence. Now, first question I am going to ask is, why are we using the word registrant? What is the purpose of this? So let me explain this. Registrant is one type of taxable person. So if you divide the bigger terminology, taxable person, it will be two categories. One, registrants who have a TRN, and then there will be other people who are required to register with the VAT because they are taxable persons, but they still haven't registered. Those are also taxable person. Those are also taxable persons, but they are not registrants. We can't call them registrants. So wherever you read the word registrant, remember that we are talking about a taxable person who has a TRN. So registrant holds required evidence. First point. A taxable person is able to recover input tax in the first or subsequent VAT period immediately following the tax period when the required conditions are met. So a registrant can recover input tax when the conditions are met. How? What are those conditions? If input tax is not claimed in one of these two VAT periods, it may only be recovered subsequently through voluntary disclosure. If you did not recover this in the period of incurrence or the very next period, then you have to give a voluntary disclosure that we forgot to recover it, so please approve. Uh, so approval as such does not happen, but the point is that why get into voluntary disclosure? Because voluntary disclosure is a trigger point for FTA to start probing into the return unnecessarily. So we have to be diligent about it. The taxable person must receive and keep a valid tax invoice. Okay. Taxable person has to have a valid tax invoice of the VAT law, which contains the appropriate information as detailed in Article 59 of the regulation. So Article 59 provides the type and particulars of the information that are required in order for recovering the input VAT. In the absence of a tax invoice, other documents may be acceptable as per the VAT law and regulation at the discretion of the FTA. Note that there may be situations where a clearing agent imports goods on behalf of a non-registered importer. Okay, non-registered importer. The agent in this case would declare its own TRN on the custom import declaration and should be responsible for the payment of VAT in respect of the import in its own VAT return, because the C agent was importing the goods for a non-VAT registered importer, or even non-registered importer. Forget about VAT, non-registered importer with the authorities, with the customs authorities. So the importer on the record is the agent. The whole VAT liability falls onto the agent. He has to account for the input VAT, etc. He can pass on the burden through price, but that's a different matter altogether. However, since the clearing agent or equivalent business is not the owner of the goods, but simply facilitates the import of those goods into the UAE, it should not recover the import VAT as its own input tax in the VAT return. Instead, if the VAT is paid by the clearing agent or equivalent business, it can be recovered by the agent directly from the importer. To do so, the clearing agent or equivalent business must issue a statement to the importer which contains at the minimum the following details. So there are some details that are required uh, in that are required to be put into the statement: the name, address, and the TRN of the clearing agent or equivalent business, the date on which the statement is issued, the date of import of the relevant goods, description of the imported goods, which is sufficient to identify them, and the amount of VAT paid by the agent to the FTA in respect of the imported goods. So these are the particulars that the clearing agent will provide to the importer. As per Article 50, Clause 8 of the regulation, and we are talking about the executive regulation, VAT executive regulation, UAE VAT executive regulation, the statement issued by the clearing agent is treated as a de facto tax invoice for VAT purposes. This statement from the clearing agents is treated as a de facto tax invoice. Consequently, therefore, the importer can rely on the statement to recover VAT when available. For example, once they register for VAT, importer was not registered. They had to utilize the services of the clearing agent. They cleared it, they paid the VAT, everything, and then they provided the statement to the importer, that non-registered importer who did not have a TRN. Later on, when that importer gets actually registered for VAT based on this statement that the clearing agent had provided, they can recover input tax, the pre-registration input tax. Article 55, Clause 2 and 3 of the VAT law state that the taxable person must receive and keep both invoices and import documents in relation to any goods and services that have been imported. So taxable person have to have all the import documents. Payment of the consideration. Article 55 of the VAT law states that the taxable person can claim the input tax if they pay the consideration or any part thereof. What does the Article 55 say? Taxable person can claim the input tax if they pay the consideration or any part thereof. The amount of tax that can be recovered by a taxable person in the tax period in relation to the supply of goods or services made to them is the amount of input tax that relates to the portion of consideration in respect of the supply that has been paid during that tax period. So how much actually the price has been paid, only to that extent the VAT can be recovered, or the payment that they intend to make before the expiration of 6 months after the agreed date for the payment. So, maximum, leeway time or a delay or a slack time is 6 months. So you had a date, agreed date of payment. Beyond that date, 6 months are allowed. If you don't pay, then that input tax recovery will become questionable, and you will need to, uh, make an adjustment for that input tax. You will need to forego the benefit of that input tax recovery. FTA has issued a public clarification on time frame for recovering input tax. Based on this public clarification, input tax must be recovered in the first tax period in which the following two conditions are satisfied. So there are two conditions which need to be satisfied. So input tax must be recovered. What are those two conditions? The tax invoice is received. So first of all, tax invoice is received and an intention to make the payment of consideration of the supply before the expiration of 6 months after the agreed date of payment is formed. So, the buyer confirms that we will pay this amount on the agreed date, or if there is a delay, maximum delay of 6 months. Within 6 months of the agreed date, we are going to discharge or settle this invoice. Upon receipt of a tax invoice, a taxable person can recover input tax only when an intention to make the payment within a prescribed period is formed. Intention has to be there to make the payment. Therefore, if the intention to make the payment is formed in a tax period which is later than the tax period in which the tax invoice is received, the input tax can be recovered only in the later tax period. So input tax in the tax invoice was received, but the date was not, crystallized, the date of payment. So once the date of payment is crystallized, once it is agreed, beyond that date, 6 months slack time is allowed. Public clarification on time frame for recovering input tax expands on the meaning of condition B above, the intention to make payment. For businesses with a process for approval of invoices for payment, the intention to pay is treated as arising only once that internal approval process is completed in respect of the invoice in question. So, that's a very interesting angle. For business with a process of approval, if the business has an approval process for the payment, so what will happen? The intention to pay is treated as arising once that internal approval has been achieved. So beyond that point, 6 months, slack time will be allowed. And even if within those 6 months payment is actually not made, then the whatever input tax recovery benefit was claimed, it will have to be reversed. If the input tax is not recovered in the first tax period in which both the conditions were satisfied, the taxable person can still recover it in the next tax period. Uh, The Article 55, Clause 2 of the VAT law says that if input tax is not recovered in the first two tax period, it is still possible to recover it via the voluntary disclosure process. There is a public clarification on that, VAT P017. So if within the first two periods you do not recover or claim the benefit of input tax, then in any subsequent period, if you try to claim it, then you will have to give a voluntary disclosure. So now we are coming to blocked input VAT. The name blocked is a connotation that, recovery is blocked. So what will be the accounting meaning of that? The blocked input tax will become a loss. It will have to be expensed out. It will result in reduction of the profit for the year. Article 53 of the regulation, VAT executive regulation, UAE VAT executive regulation specifies that input tax is blocked from recovery from the FTA in relation to what? Entertainment services provided to persons other than employees. If you're providing entertainment to the employees of the company, that VAT will be recoverable. But other than employees, that input tax will not be recovered unless the person is a government entity as specified in a cabinet decision. So if it is a government entity, then entertainment services to whomever it is provided, the input tax will be recoverable. If you remember corporate tax law, there is a similar provision to it. So entertainment services expense, entertainment expense provided to employees is recoverable in full and only 50% to other than employees. Motor vehicles purchased, rented, or leased that are available for personal use by any person. Now, that is a tricky point, please remember. And it has been examined multiple times in the VAT diploma exam. So even if partially or a small portion usage for motor vehicles is done by the company executives or the owner, the entire input VAT related to motor vehicles will become disallowed. You cannot claim the benefit. You will have to block it. It will be expensed out. That's a tricky thing. Remember this. Goods and services provided free of charge to employees and for their personal benefit. So all of that input tax free of charge to employees, if goods and services are provided, all that input tax will become blocked input tax, except in certain cases discussed below. So there are exceptions to the general rule. Let us look at it. Entertainment expenses, client entertainment. Input tax is not recoverable if it is incurred in the provision of entertainment services to anyone not employed by the taxable person. So it is not recoverable. This includes customer, potential customers, officials, shareholders, and other owners or investors, as long as they are not employees. Sometimes shareholder can be an employee. So we have to be careful about it. The phrase entertainment services means hospitality of any kind, including the provision of accommodation, food, and drinks. So, hospitality of any kind, that's the broad memory hook for us. It could be accommodation, food, drinks, which are not provided in a normal course of a meeting, normal course of meeting. Access to shows or events, trips provided for purposes of pleasure or entertainment. All of these are entertainment services. This is Article 53 of the Executive Regulation. Provision of catering and accommodation services will not be treated as entertainment services where it is provided by a transportation service operator. For example, an airline to passengers who have been delayed. Yeah, that's a logical point because airlines are required to provide that accommodation because of the delay. So that's normal course of business. So it's not entertainment services, and the VAT will be recoverable. FTA issued public clarification on now. Be careful because this delay related input tax recovery can be examined. The FTA issued a public clarification on non-recoverable input tax entertainment services. This is a VAT public clarification number VAT P005, in which it stated that for simple hospitality that is provided in the normal course of a business meeting, the cost is considered to be recoverable. A normal course of business. Additionally, the following criteria is indicative of simple hospitality during a business meeting. The hospitality is provided at the same venue as the meeting. So no special arrangements or hotel bookings are done. Wherever the meeting was happening, if it was a hotel, fine, the same venue will be acceptable. But if it is, conference room of the office, fine, the hospitality is provided within that same place. If the meeting is interrupted, this should be a short break for the provision of hospitality, and the meeting should resume as normal. Usually, in conferences or meetings, 15 minutes tea break, coffee break is there. Some snacks are there, so that would be recoverable. That will be normal course of business. The cost per head of providing the hospitality should not exceed any internal policy the business normally has in place, such as around employee subsistence claims where available. So basically, this is all, the criteria is reasonableness. Okay, there is no hard and fast rule as such written for that, but it will be considered as a benchmark treatment. Usually what kind of entertainment is provided, that benchmark will serve in this normalcy benchmark. The food and beverage provided should not be accompanied by any form of entertainment. So yeah, I mean, food and beverage is acceptable. Based on the public clarification, when entertaining becomes an end in itself, very, very important criteria. When entertaining becomes an end in itself, for instance, a taxable person inviting clients to a show, event, or trip provided for the purposes of pleasure or entertainment, input tax is blocked. So, like annual retreat. Now, what about annual retreat? The whole point of annual retreat is entertainment, pleasure. So, I mean, any input tax incurred on that will be blocked. Based on some public clarification, a designated government entity, which is specified in the cabinet decision, can provide entertainment services to anyone not employed by the entity and is able to recover the input tax incurred on those costs. But that is only for designated government entities. This exception for designated government entities only applies to entertainment provided to non-employees. For example, the following can be considered to be uh, in the course of the listed sovereign activities linked to the designated government entity, and any VAT incurred should be recoverable. Some instances are given. And now these designated government entities, what do we mean by that? The embassies, for example, that are there in UAE. So American embassy, Pakistani, Indian embassies, etc. Meetings with the delegations from other countries where lunch or dinner is provided, meetings with representatives from other government entities to discuss official businesses where refreshments are provided, ceremonies held to mark significant political events, signing of an international agreement where entertainment is provided to the audience. All of these are examples where input VAT can be recovered. Goods and services provided to employees. Where a business purchases goods or services to be used by employees free of charge and for their personal benefit, including entertainment services, the input tax is blocked except in the following cases. What are those cases? Where there is a legal obligation to provide the goods or services under applicable labor law. So if there is a legal obligation to provide, then the input tax will not be blocked. Because this will be an exception, except in the following cases: where there is a contractual obligation to or documented policy, the goods or services are provided to employees in order that they may perform their role, and it is normal business practice for the employer to provide them. So many multinationals have a routine that every morning or other morning some fruits may be provided, or there are coffee vending machines, etc. Or maybe sometimes lunch is provided to employees as a routine practice. So those will be admissible expenses. On those input VAT will be admissible. The benefit can be claimed without prejudice to the first point, where the taxable person provides health insurance, including enhanced health insurance to its employees and their family members as applicable, up to a up to a husband or one wife and three children younger than 18 years. So To that extent, if there was an input VAT on health insurance also, that will also be recoverable. Where the provision of goods or services is a deemed supply. So deemed supply, those goods that are supplied, we discussed that earlier, and those goods which are supplied without consideration, maybe change in the use of a business asset, or all those assets which were standing in the balance sheet at the time of deregistration. All of these are deemed supplies. So provision of goods or services, where the provision of goods or services is a deemed supply. So in that case also, this would be an exception. For example, where a new employee joins a business and is provided with hotel accommodation for a short initial period prior to finding their own accommodation. All the big fours do that in UAE, by the way. This would not be considered entertainment, and the VAT incurred on such costs would be recoverable, as the cost is necessary for the purposes for the person to perform their role. So that's a normal course of business. However, where a business organizes a lunch or dinner for employees, this would be considered entertainment, and the VAT incurred on such costs would be blocked from recovery. A practice point here is that the company as well as the tax advisors have to practice extra, skepticism. So sometimes, it is better not to claim input VAT where there is a significant amount of doubt. Why? Because you'll be claiming a relatively smaller benefit, but the penalties for that would be significant. The general rule is that when any entertainment is provided, which is not incidental to a meeting or a business trip, where any entertainment is provided which is not incidental to a meeting or business trip, the input tax will be blocked. Entertainment cannot become an end in all the scenario. This would include, for example, a birthday party for a member of the staff, or a staff outing to a dinner, and a concert where no input tax would be recoverable in any of these cases. So yeah, the entertainment must not override the event, the intention of entertainment. Motor vehicles. Input tax is not recoverable if it is incurred in relation to the purchase, rent, or lease of a motor vehicle for use in the business, where that motor vehicle is available for private use by any person. Now, this, as I said earlier, is a tricky one. A motor vehicle in this instance is a road vehicle. Now, this is a definition of motor vehicle. This can be examined, and it has been examined. A road vehicle which is designed or adapted for the conveyance of no more than 10 people, including the driver. A motor vehicle excludes a truck, forklift, hoist, or other similar vehicles. Be very careful about this. So buses will not be considered as motor vehicles because bus is like 30 people, or much larger capacity. So, motor vehicle, there is very strict provision on this. If it is even available a little bit of private use also, the input tax recovery benefit will be gone. A vehicle is deemed not to be available for private use where it is a taxi licensed by the competent authority in UAE. So if it is a taxi, then this private use matter will not come. An emergency vehicle, including police, fire, ambulance, or similar. So if it is an emergency vehicle, uh, this private use criteria will not hold. A vehicle which is used in a vehicle renting business where it is rented to a customer. So please remember this vehicle related matters have been examined extensively. Employee mobile phones, airtime and data packages. This is so in the recent exams of VAT diploma, this might not have come. So this is a likely question. So the FTA issued a public clarification VAT P028 relating to businesses providing mobile phones, airtime and data packages for employees' use. This was introduced in response to the increase in remote working from 2020 onward. That's why I said this is a relatively new topic, where these facilities are provided to employees solely for business purposes, and where the employer maintains a strict policy restricting the use to business purposes, this will not be treated as a personal benefit for the employee. What does that mean? Input tax recovery will be allowed. To be entitled to input tax recovery, the employer business must contract directly with the supplier. So business has to contract, cannot be the employee has contracted and recovering, and hold a tax invoice showing this. The employer must be able to demonstrate that it robustly monitors the use of the mobile phones, airtime, and data packages by employees, and that it makes appropriate action where these are used for personal purposes. What could be those appropriate actions? Recovery of personal calls, for example. Additional, Additionally, the employer must also have robust policies, procedures to ensure that there is no personal use. Employer must also have robust policies and procedures to ensure that there is no personal use and it is regularly monitored. If these requirements are not met, the recovery of input tax incurred in respect of phone, airtime, and packages would be blocked in line with Article 53 of the Executive Regulation. Now we are coming to the input tax adjustments. As per Article 59 of the VAT law, VAT decree law, there would be an input tax adjustment in the following situations. If the taxable person attributes the input tax to making taxable supplies, but later changes the use or intended usage prior to making the taxable supplies. So if that is the case, then input tax recovery would need to be adjusted. If the taxable person attributes the input tax to make exempt supplies or non-business activities, but later changes the use of intended usage prior to making exempt supplies. So instead of making exempt supplies, the usage of that particular asset or supplies goes towards the taxable supply. It starts supporting taxable supply. So those assets, any input tax related to those or those expenditures incurred, that will from now on start supporting the taxable supplies. Input tax will be eligible for recovery. So change in usage will require adjustments. Article 56 of the regulation provides further detail. If input tax has been recovered because it was attributed to the making of supplies, but before the consumption of those goods or services upon which that tax was incurred, the input tax becomes not so attributable, then the taxable person is required to repay the input tax. A vehicle is a beautiful example. Like the vehicle was purchased for business purposes, but then later on it was the usage of the vehicle shifted from business purpose to private use of the CEO, for example. So if the company had already recovered the input tax related to that vehicle, now that input tax recovery benefit will need to be reversed and an input tax adjustment will need to be passed. So basically the extra money will need to be paid to FTA. The opposite is also true. If input tax was not attributed to making of supplies, but before the goods or services are consumed, it becomes attributable to making of supplies. The taxable person shall be able to recover input tax. Wherever the word supplies is written, please read it as taxable supplies because you can recover input tax only on taxable supplies and deemed supplies. Deemed supplies are also taxable supplies. If the input tax was subject to an apportionment, you remember mixed use, like an ERP that is helping record all the accounting for all supplies, whether exempt or taxable or out of scope. But so that's a mixed use input tax. But before consumption of the goods or services upon which that input tax was incurred, the use of that input tax changes, then it should be adjusted as follows. So there is a mechanism. How? If it becomes attributable to taxable supplies, then the taxable person should be able to recover input tax not previously recovered retrospectively to the extent it is attributable to the use of goods or services for making such taxable supplies. So you can recover the input tax which previously you did not claim. You blocked it or you expensed it out. Now you can claim because before the consumption, the usage has changed. If the input tax ceases to be attributable to taxable supplies, then the taxable person shall be required to repay that input tax. That's what I said earlier. More money will need to be paid in terms of VAT to the Federal Tax Authority. These are the two important adjustments. One is a reversal of input tax claimed, and the other one is benefit claimed, which was previously not claimed. The adjustments described above are only to be made if the following conditions are met. So these adjustments we can do only if conditions are met. What are those conditions? The change in use occurs within 5 years. So whatever change in use these that we are talking about, the time limit is 5 years of the date of supply of the relevant goods or services. So even if it is a previous input tax that we let go, we did not recover during the last 5 years, but now that vehicle is being used for taxable purposes, we can recover the input tax. The taxable person is not required to make an adjustment for the same input tax under the capital asset scheme. So capital assets being very, large sized assets, meaning in terms of monetary value, 5 million and above, or under input tax apportionment rules. So, capital, if these are capital assets, this adjustment will not be applicable. The taxable person is not required to make an adjustment for the same input tax under the capital asset scheme or under input tax apportionment rules. So there, in previously there was overheads, mixed use overheads. So you don't need to, start analyzing the mixed use overheads over a period last 5 years. No need to do that. So that's about it. This was related to input tax recovery. This was chapter number 10, which was input tax recovery.